Again, as a quick review, these board boot camp sessions follow along with the format of the Land Trust Standards and Practices, which are a body of guidance that are compiled by the Land Trust community and conservation professionals and are codified and maintained by the Land Trust Alliance. The Standards and Practices were last updated in 2017, and they're comprised of 12 standards that address important topical areas that are common to all land trusts, the first half of which are pertain to nonprofit organizations generally, and the second half, which are specific to land trust, land protection, and stewardship. And the standards also easily organize into 4 topical buckets: governance, financial management, land transactions, and stewardship. So last week we looked at governance, and tonight we'll look at financial management. The standards addressing financial management are primarily found in Standard 6, but there's also sprinkled here and there in Standard 3, which we reviewed with governance, Standard 5, which concerns fundraising, and Standards 11 and 12 as relate to stewardship expenses. So why are we back here in Standard 3 about governance? Because while it's the bookkeeper, the staff, the treasurer, the finance committee, or some combination thereof that is likely doing the work of financial management, it's ultimately the full board's legal responsibility to make sure the organization is financially stable and sustainable. And so that means that as a board, you must set an annual budget and have knowledge of it, and the budget should be balanced in the black and allowing the organization to build resources and not negative spending. In order to do this, the full board should receive regular financial reports at a frequency that's appropriate to the scale of the organization and presented in a format that allows each board member to understand the financial status and be able to discuss it during board meetings as necessary. The full board should, usually with the help of the finance committee or an audit committee, the full board should receive and review a copy of the annual audit or review, and the board should be involved in setting policy regarding the investment and management of your reserves. So some of this is addressed in a more detailed fashion within Standard 6, so we're just going to press on. All right, the first practice within Standard 6 is about the budget. While the budget is often developed by staff, committee chairs, the treasurer, and the finance committee, each year the board should receive a draft budget for its review and adopt it within a meeting, the vote on which is then recorded in the minutes. Recall from our session on governance, the concept of the budget as one component of that 3-legged stool, working together with the annual work plan and the fundraising plan. And so in your board role, you should be making sure that the budget contains anticipated expenses for the activities that you may be responsible for over the course of the year. I put a note on this slide because I'm often asked about the timing of fiscal years. Many land trusts use the calendar year, January to December. However, some have moved to a mid-year calendar, July to June, and I've also seen October to September. The decision usually comes down to periods of cash flow and personnel resources. So for example, many of our organizations do like an end year appeal, which can result in income that spans the calendar year. You know, some comes in December, and then some comes in January and February, which can make it difficult to assess and compare membership income year over year, because you'll always have parts of 2 campaigns in each year. Another example is organizations that rely year over year on grants. When the activity happens in one calendar year and the receipt of the funds in another, they might want to adjust their fiscal year to make the accounting easier, as well as make it easier for the board to understand the organization's financial status, instead of having all kinds of receivables booked. Personnel-wise, an organization with a ton of activity in the springtime might adjust its fiscal year to avoid having the press of the audit season in like the period from March, April, and May. So I have some examples of how the board might encounter the budget throughout the year on this slide. If quarterly or mid-year reviews indicate that the organization is way off the budget, it might even be warranted to do like a mid-year budget modification. I also have a note on this slide about accounting software, and anecdotally, I'd say that most land trusts that I've encountered use QuickBooks. If you recommend any others, please put this in the chat because it's nice to know what people are finding success with out there. Accounting software is pretty much a must today, and it really does make reporting so much easier. Within this first practice of Standard 6 also comes the warning that the board should not let a trend of negative spending deplete its reserves. So we need to plan for a perpetual life. So if negative spending is an issue in your organization, you need to make a plan to get out of that pattern. And the board should be thoughtful with regard to its ongoing income sources to ensure stability in case one or more of its usual sources becomes temporarily or permanently unavailable. And some of us experienced this firsthand during the pandemic when we couldn't host our usual in-person fundraisers. So over-reliance on one source can leave an organization vulnerable, and it's important to have a really good understanding of where your income's coming from so that you can make plans to diversify somewhat. All right, next slide. To avoid crises, we're still in practice A of Standard 6. It's chock full. To avoid crises that are related to the loss of an income source or negative spending year, the first practice of Standard 6 is also about building reserves, which include operating reserves, unrestricted funds that can cover regular operating expenses. The best practice here is to have at least 3 months worth accessible to meet operating needs in case there's something that prevents the income that you're planning for from coming in. Although I would say that many organizations reserve 6 months and maybe as much as a year of operating expenses. For many organizations, the operating reserve is simply the main bank account. So it's just a bank account that can provide for more than 1 month's worth of expenses. I think that's pretty typical. Invested unrestricted funds can also be considered an additional reserve for operating needs, so long as the investment instrument allows for easy access to those funds. Besides operating reserves, we also want to have stewardship reserves because we need to take care of and protect our easements and our fee properties, and we have to do this forever. But what is sufficient? What does that mean? How do we estimate what we're going to need in reserve? The Land Trust Alliance has collected a number of helpful guidelines. Number one, for defense of your properties, legal defense that is, the Land Trust Alliance has developed using actuarial data collected within the Terra Firma Conservation Defense Insurance Program, a calculator that takes into account a land trust properties, experience, and demographics in providing a suggested amount that you should have on reserve. So if you're unfamiliar with the Land Trust Alliance's legal defense calculator, it can be a really interesting tool to do with your organization to see what the recommended level of stewardship defense reserves might be for you. And for monitoring of properties, your internal analysis of what you might need shouldn't assume if you're using volunteers to monitor that you're going to be able to continue this in perpetuity with no personnel expenses whatsoever. So for monitoring, to know what you might need on reserve for monitoring your properties, it's a better practice to track the number of volunteer hours that are contributed each year by your monitors and base your reserves on what might be needed if you had to pay a contractor or staff to do this task. So note that for accredited organizations, your reserves must meet the level of at least 3,500 per easement property. So that's like the one accreditation focused guideline, the legal defense calculator for your defense reserves, and then 3,500 per easement for monitoring. And for fee properties, it's a little bit more up to the organization to think about what it actually spends on monitoring. Ultimately, we should look at each new property when we protect it to assess and estimate its unique risks and needs. So you could look at whether the property is large or small. If it's an easement, does it have substantial reserved rights? Is it bordered by properties that suggest high or low risk of trespassing, vandalism, or encroachment? Is there a survey? And are property boundaries physically monumented or otherwise well marked to make it easy for you to monitor? Those are some of the considerations that you'll take into account when you're protecting a new property and setting aside new stewardship reserves. The next slide is just a picture of this legal defense reserves calculator. I think it's really helpful, so I encourage you to check it out. And you can get to it from the Land Trust Alliance Learning Center as well as through the Terra Firma Defense Insurance Program's website. And I did put hot links on this slide to get to those.
Connie, just real quick, you don't have to be a participant in Terra Firma, do you, to use the calculator?
You don't have to have purchased Terra Firma Defense Insurance, but you do need to be a member of the Land Trust Alliance because you'll need your sign-in that you would use for the Learning Center to get into that website.
There are some questions accumulating in the chat. The only one that you might want to speak to right now, though, is there was a question about accreditation. Accreditation by whom? By just maybe noting that for people who are less familiar.
Sure, I'll do that right now. And then, we have a few more slides to get through, and then we'll take a substantial break for questions. But the Land Trust Accreditation Program is, just what it sounds like, a program that accredits land trust, and it is based on a risk analysis. It's based on compliance with laws, and really adheres pretty well to these standards and practices that we're reviewing. I don't know off the top of my head how many land trusts in our nation are accredited, but at this point it's a substantial number. It accounts for, I think as much as 70% or more of all privately protected land in the United States. It's a fairly rigorous program, but for any of you who have been involved in accreditation programs with hospitals or medical facilities or schools, I can tell you that it's much easier than that. Anyway, something to look into, and I'd be happy to answer more questions about it or to talk offline with anyone who's interested in what it's like to prepare for and then go through the accreditation application. All right, so we're going to move on to practice B in Standard 6, and the remainder of Standard 6's practices are not as dense as that first one. Practice B is about financial record keeping and using an appropriate basis of accounting, which means generally accepted accounting practices or GAAP, or the fun to say ACBOA. And the preference for accrual as opposed to a cash basis presentation is because the accrual method really more effectively presents the organization's financial situation with respect to its available funds, as well as its future expense obligations. So to press that point home regarding available funds, as well as future expense obligations and keeping appropriate records to show this, recall how last week we covered Standard 5 and the responsibility to be really clear about funds solicited for specific purposes. Funds that you receive as donations might be donor restricted. They might even be restricted forever and ever, as in case of a true endowment where the funds are meant to throw off income, but the principal never touched. And some donor restricted funds are restricted in terms of when and on what they can be spent on. So Standard 5's provisions remind us that when donors make gifts for restricted use, this should be made clear within the organization's documentation of the gift, including its thank you letter, but also its bookkeeping that's associated with that gift. I have language on this slide about what goes into a donation thank you letter, otherwise known as the tax acknowledgement letter, and recognizing that composing and sending these letters is often a function of just one person in the organization, not the entire board. I'm not really going to spend a lot of time on this, but I do invite your questions if you have any during our pause. All right, to round out our discussion of financial record keeping, you might hear about organizational funds that are board designated, funds that aren't legally restricted pursuant to donor stipulations, but which the board has decided together would be best earmarked for potential expense needs. And stewardship reserves are one of those categories. It's common practice for stewardship reserves to be comprised partially or maybe exclusively of board designated funding that is otherwise unrestricted by donors. Many boards also set aside land protection money, sometimes referred to as strike funding or an acquisitions reserve, to provide for acquisitions related expenses when time is of the essence. Before leaving financial records, we're going to revisit Standard 3 and that governance responsibility to keep the board apprised and accountable. And that means that periodic financial reports to the board, and this might be every meeting, it might be quarterly, it might even be semi-annually, depending on the size and the scope of the organization's activities. Reports should be provided in a manner such that the board can know whether there are adequate funds on hand to implement the budget and provide for future solvency. And so these reports would usually include a balance sheet that indicates not only asset values, but also the allocation of these assets among unrestricted, board designated, and donor restricted funding to help you know what's available for expenditure right now and what can only be spent on certain things or perhaps never spent at all. Besides the balance sheet, there should be a statement of activities, also known as a profit and loss statement or a P&L, showing the organization's performance within that reporting period. And it's helpful to present both reports with comparison information to provide context and further insight. So for example, the balance sheet might include a comparison against the end of the last fiscal year or the same time period last year. The P&L can likewise use comparisons versus the prior year at the same period, or perhaps a comparison against the budget, or maybe both of those things. Usually, the treasurer would review the reports in the context of a board meeting, with the report and discussion included in the minutes to provide a record of the board's conversation. It might be additionally helpful for the treasurer to provide a cover memo to the reports, kind of calling out to the board's attention the significant details of that particular report and reporting period. All right, just a couple more, maybe only one more before we pause. Staying within Standard 3, one more moment, just a quick note on policies for investment and management of funds. The board should adopt written policies and procedures for the investment and management of its financial assets beyond its current operating funds. And there are templates for these that you can find on the Land Trust Alliance Learning Center. They can be more or less complicated depending on the organization's portfolio, the amount maybe of its unrestricted assets that are available for investment would be one factor that would indicate how involved of an investment policy you might want. Donor restricted assets left to the organization's management would be another factor that would have an implication on that. And then finally, the status of any board designated funding. But whatever your organization's unique situation is, you're going to want to consider the organization's prospective need for that funding, which is going to determine your need for liquidity for whatever investment you choose. So a good example of this might be with board designated reserves for acquisitions strike funding. You would want to make sure that that strike funding was readily available to you because it's there in case there's an emergency and you have to move on something quickly without doing a fundraising campaign, right? Community foundations with bureaucratic processes for getting your funds back are usually not the most appropriate place for that strike funding, but can be very good for the investment of an endowment. The organization's level of risk tolerance is another another factor here. Some board members are more experienced with investment management than others, but regardless, I find that nonprofit organizations are usually more conservative due to their fiduciary role of stewarding public funds And land trusts in particular have to take a very long view in terms of their investment returns. So I find that generally people are pretty conservative in their investments here. All right, so we're going to take a pause, and I'm going to come off of the screen share so that I can see all of you and get to your questions for a few minutes.
Connie, do you want me to read from chat, or would you like to read them yourselves?
It would be super if you could read them to me. Thanks.
Yeah, so the first question from John is, must the annual budget always be in the black?
No, John. There are times when it might make sense not to have, where you're going to show a deficit. Occasionally land trusts are working on, a big land protection or another project, and you're just going to have a year that's extraordinary in terms of your expenses. And if your income levels are fairly flat year over year, then you might have a budget that was in the red. You don't want to have a trend of negative spending, because we know that those trends eventually lead to an empty reserve situation. So it's okay to have a year or maybe even two if it's planned, and it's really good if your board understands that it's made a conscious choice to do that in order to get the good work done that kind of a budget implies.
Another, just a comment on your software question. Vidya notes that in Massachusetts, the trustees use PowerPlan as their software. Very big organization, and maybe that's why. Steve has a question. I'd be interested if anyone does classes to better format QuickBooks data for understandable reports to the board. And classes are a particular grouper, term in QuickBooks. So maybe if somebody uses classes, they might, in QuickBooks, they might drop him a note in the chat. That's Steve McPike, to network about that, perhaps offline. But Connie, I don't know if you have experience with classes in QuickBooks.
Like only enough to make me really dangerous. I'm not a bookkeeper, and actually, I think it would be. When you first said classes, I was like, I want to sign up for a class in QuickBooks, because I haven't really found like the QuickBooks training that is really helpful for organizations like land trusts. And so I have a feeling that a lot of us could benefit from that kind of a class. So anyway, I hope that somebody will be able to answer that question.
And, while we're at it, if anybody has found a good training program or class for QuickBooks, you could drop that in the chat as well. Another question, the next question was from Mark about accreditation, which I think we did answer. So it's the Land Trust Alliance. It's actually a subsidiary of the Land Trust Alliance, the Land Trust Accreditation Council, I think it's called, that does accreditation. Commission, yes. Thank you. And then another question from Steve, what's best practice for setting a close date for entering financial info into the accounting system, monthly or quarterly, by the 10th of the month? Is there a particular standard one should have?
You know what, I'd be interested in having other people answer in chat that question. I think it's got to, depending on the size of your organization, you may go, like I always heard you close the books after the year has ended and you've had the opportunity to enter all of the last little nigglies, receivables and payables. And so, anything that's trickling in after the close of the year, you wait until you can get that in and reconciled, and you close your books as quickly as you can after the close of the year. But maybe that's not the best practice. I don't know. I think monthly seems too frequent for most of our organizations.
Yeah, so if you have comments on that, feel free and add them into the chat. And the next question is about, do you have comments? This is from Sam. Do you have comments on using variance reporting in P&Ls, profit and loss statements?
Not specifically. What I would say is, the most important thing is delivering a report that, A, is accurate, but B, that can be readily understood by the board. And so, producing reports with a lot of information is terrific, except that you want to interpret that information for people that maybe are not as deep in the books or the bookkeeping as the person producing those reports. So I think that you need to find that fine line of, how can I present a really full picture to the board so that they understand the board's finances and understand, what they're responsible for in terms of fundraising and adhering to the budget and stewarding, the organization's financial resources. But you don't want to overwhelm people with reports that they can't understand and that may be, too granular, too detailed to be helpful, in the context of a board meeting.
The next question is about, from Nikki, do you have thoughts on best practices to record restricted funds in QuickBooks to display on the balance sheet?
I would consider making, you should certainly have accounts that restricted funds are booked into, and depending on the actual restricted fund, you may have a separate account line that is just for, one particular pot of restricted funding. So, but you're absolutely going to want to find some way, within your accounting system to segregate those funds. And I don't mean by opening another bank account. I just mean by, booking them in such a way that it's really evident what they are and what they're there for. And you don't have to, some people do it as they go along, but you don't necessarily have to release funds from restrictions, at the very second that you make an expenditure. You could do that on a quarterly or a semi-annually or even an annual basis, depending. But you want to make sure, that you are able to accurately present, what is available and what it's available for.
There's a question from Barbara from Minnetonka Land Trust. I'm going to actually, so she's asking for a specific referral to somebody who could help with their books. Barbara, this was a recent question on the Massachusetts listserv. So I'll email you offline about that because there were some names that were thrown out. But if anybody on this call has referrals, feel free and pop them in there if you're using an accountant to work with you that you think would be useful. She's out in the Connecticut Valley, Western Mass. If you have a referral for her, pop that in the chat. MA has posted something on YouTube, and I don't know, maybe MA, if you want to come off chat and just tell us what you've posted, come off mute and just tell us what you've posted, feel free.
Yeah, sure. So the link I shared is QuickBooks repository on YouTube for educational videos on how to use QuickBooks.
Wonderful. Yay, that's excellent. Okay, and then Todd has a question. I have some experience in classes with QuickBooks. Happy to connect offline. That's Todd Berry, another good resource. Thank you. And then I see MA has noted what his link was for. So that's excellent.
All right. So the next practice in Standard 6 involves the annual review, which is conducted by an external independent accountant. Recall that we touched on this briefly last week. Whether an organization engages its CPA to conduct a full audit, a financial review, or a financial compilation often depends on the size and the scope of the organization. So smaller organizations are usually not required to obtain a full audit, the expense of which might not really be justified given the number of transactions over the year. There is a threshold above which state law might require an audit. So even a small organization might be required to undertake an audit if they've received substantial government funding for a land protection project. And accreditation, there it is again, does require organizations to get an audit, a review, or a compilation at certain levels of annual income. Usually, it's the finance committee, sometimes a smaller committee thereof, or a separate audit committee, which deals with retaining and corresponding with the accountant during the preparation of the report. And when the report is complete, it should then go to the board for its review and acceptance. The board's review will include a review of the notes to that report, which provide additional detail on funds that are donor restricted or board designated. And the report might include a governance or a management letter that would identify any deficiencies that need to be addressed by the organization, such as using a cash basis as opposed to an accrual method, or maybe having a lack of or a deficit in an internal control that creates a risk of misuse or misappropriation. When an organization receives a management or a governance letter that takes, that calls out one of those deficiencies, the organization should respond to the concerns in the letter in writing with respect to the corrective action that it intends to take. Often, the annual IRS Form 990 tax return is compiled in conjunction with the annual audit or review. And this is because organizations might wish to wait until the audit is final to complete the 990 in case any adjustments to its books are needed. A recommended process for the 990 includes distribution of a final draft to the board for review, discussion, and a vote to authorize its filing before it gets filed. Board minutes should reflect the board's review of both the audit report and the 990, and the vote to authorize filing the 990. Okay, so next is practice D, internal controls. What does it mean to have internal controls in place with respect to financial management? It means that organizations should think about their unique financial risks that are associated with theft, misappropriation, maybe payment of an invoice for work that didn't happen would be an example of that. Misuse of funds due to mistake or miscategorization, so the wrong person gets paid, or donor restricted funds are spent on something that they shouldn't be used for. Misallocation or mistakes in reporting, errors in bookkeeping, loss of funds, a donation is misplaced or destroyed, or an investment goes south. These are some of the most common financial risks that land trusts, that nonprofits like us might encounter. And here again, internal controls is an area that's going to vary with the size and the scope of the organization, recognizing that a small or all volunteer organization doesn't usually have the depth of personnel that a large organization with an HR or a finance department would have. So their controls might not be quite as involved. But also organizations dealing with smaller levels of assets have a smaller magnitude of risk. So there's going to be a lot of variation among different organizations on the internal controls that they adopt and practice. But regardless of an organization's size, internal controls are about building in checks and balances so that more than one person touches each income and expense transaction. I've listed here some common strategies for income-related checks and balances, such as having one person get the mail and another person open it, maybe building in systems where donations are reported to certain people in the organization that, maybe one person is a development person and one person is the person who compiles all of the checks for deposit. And then, of course, implementing periodic and independent reconciliations of the bank accounts. And for expense-related checks, ensuring that the person who ordered the work, reviews and okays invoices that are presented for payment, and then once that okay happens, having another person, prepare and make the payment. A really simple one is using two people together to count cash receipts at the end of an event when cash is collected. So usually what you do is you'd have two people with fiduciary responsibilities, like two board members, count the cash, come up with their number, put the cash in an envelope, seal it, and each person writes the number and signs the envelope. So, but really, it might be better to limit cash transactions whenever possible as another way to check against the risk of loss. And enlisting more than one person to conduct those reconciliations is probably a good idea. So, you might have one person who does a reconciliation with the bank account going into the bank account online, and you might get another person who does it off of the mailed paper statements. Building redundancy into your periodic reconciliations is a recommended practice, and any organization can really do it. Okay. There's always going to be risks that can't be fully avoided or mitigated by prudent investment, internal controls, and the best board oversight. And so for that reason, we have insurance, and Standard 6 also covers insurance. So land trust boards should be knowledgeable about what insurance coverage they have and periodically review this to ensure that they're adequately covered. So I know that transition is a little bit awkward because we're not really talking about insurance of your financial investments per se, but Standard 6 does contain this idea that to prevent financial loss, organizations should be thinking about insurance and where they can offload or transfer their burdens for any financial liability that they might encounter. Land trust boards should really know what coverage they have. They should review it. They should periodically document it. And this should be done about every 5 years. That conveniently coincides with the accreditation term for accredited land trusts. Your organization should have general liability, which covers losses that are related to property, events, usually has your umbrella policy in it. You should have directors and officers insurance, which can also cover volunteers that are acting on behalf of the organization. Many land trusts get these first two through the Chubb Alliant program, which is located down in Washington, D.C., and offers a package that is specifically designed for land trusts. I have worked with them, and I can say that one of the nicest things is there's never any argument when when there's an accident and you have to make a claim. They're very familiar with the work that we do and the kinds of things that might happen on our properties, and I've always found them very, very easy to work with. Employers should have unemployment and workman's comp insurance. And then finally, something to consider is whether or not it makes sense for your organization to purchase conservation defense insurance through terra firma. I get asked a question about cyber insurance all the time recently, and I'd be really interested in your experiences in chat. I have not myself heard of an attack on a land trust or a land trust that has really needed to fall back on cyber insurance, but I feel that increasingly this is an area where we're all going to want to be well protected. All right, so I have my pause up again, and I'm going to stop sharing so that we can take questions and comments.
There are some questions. For land trusts, Anne asks, for land trusts with an annual budget around 250,000, how much would one spend annually on an audit, perhaps? And maybe that's something that people might respond to in chat as well.
Yeah, I think that would be good to have people's experience from the land trusts that are around you in your state. And I don't know if the pricing structure would be more keyed to the amount of your annual budget or your annual income, or to the number of transactions that your organization is doing. I can tell you that for the organization that I work with, which has an annual budget now of over 300,000 and 4 staff and quite a few transactions, that the bill for the annual audit ends up being upwards of $14,000. So it's a pretty considerable expense. It's a good thing that I really like my auditor and find the process to be painful but helpful. And you know, again, like an organization that didn't need to get an audit might consider getting something less that would assure donors that there is some independent review, but maybe not be quite so costly.
Like a financial review, for example, instead of an audit, if allowable, based on your income sources, et cetera. So yeah, if anybody has peer data that they want to throw into the chat as regarding how much y'all spend, feel free and offer that if you'd like. Another question from Barbara: Are the Chubb Alliant policies, do they offer policies for directors and officers insurance as well as for liability?
Yeah.
Yeah, I think they provide our own.
They don't mind if you shop it. So like if you wanted to purchase your D&O from, you know, a local broker, but purchase your property and your general liability through Chubb Alliant, you could do
that. Somebody says, in another job, I contracted for audits and we routinely put our audit firm out for bid, but no closer than 5 years because it's a lot of work for them to respond. So that's an interesting idea too, kind of putting it out for competitive bid to see if you can get a good price and select them based on price and qualifications. But that is a process to go through, yeah. Any other questions kind of at this juncture about anything so far?
Yeah, right. CX.
I have a question in regards to if a land trust decides to partner with a for-profit company, say for instance, like a solar panel company, and you know, clearly the for-profit company is going to pay for the parcel that they're leasing, in essence, from the land trust. Is that like a frowned upon thing? Because I don't see many land trusts doing that, clearly, because it will destroy the land, like mess with ecosystems, etc. But for the benefit of a land trust to create cash flow and consistent income, so that way the need to fundraise isn't there. I'm just wondering what the opinion is of so many board members, and have you guys, you know, or have you people just thought or decided to like move in that direction?
There are so many issues packed into the scenario that you just outlined, MA, and it would be great to have, you know, the opinions of somebody, of some of your colleagues on this call. I would just say that, like at the very outset, when you're considering a transaction like that, most of us, the property that we've protected it for conservation, and so it would be our ethical duty to ensure that the conservation values of the property were not compromised. So to hear you, you know, raise the issue of whether or not property conservation values would be impaired by allowing an activity like that would cause most of us to, you know, to abandon the consideration of a transaction like that. If you could get to the point where conservation values were not compromised, you know, then it might be worthy of consideration. But again, and I think we covered this maybe in the governance function when we were talking about fundraising. If you have a piece of property that you're considering purchasing, or you know, with public funds, or which you're considering for a donation, but not to protect for conservation values, you've got to be extremely clear about that with the donor, or, you know, if you're raising money from the public with the public, because the optics of that, of taking a property, owning a property, but not using it for conservation and rather monetizing it is something that, you know, that we want to be aware of, appearances in the community.
No, that's a great response. Thank you, Connie.
And it's not to say that that isn't done, you know, so, but it's the care that must be taken. So there are folks who, for example, take donation of property with the understanding of all parties that it will be sold, you know, even. Maybe it's a house of some value that a donor leaves to you, where it makes sense to sell it and use the proceeds. But it's about clarity and of intent by all parties, and public perception, and that it's all managed appropriately.
Yeah, of course. No, that was such a well thought out and respectable answer. I appreciate it. I'm new to the you know, nonprofit board membership, so I see I try to monetize a lot of things in my life. So when it comes to the nonprofit section, clearly I'm still learning and growing as an individual within those boundaries. So appreciate the insight.
Yeah, it's quite interesting. There's some follow-up in the chat here. Sale of timber on a forested property, that's probably a little closer to home to many of us, many of you, many land trusts where there actually could be a timber sale on a property, and maybe it could be seen as being consistent with the purposes for which the property was acquired. Perhaps it depends very much on the purpose for which that property was acquired and held, and what its conservation values are. So Tad, I don't know, in that regard, if you have a question. I know that, interesting, I just watched a very cool video about Hilltown's timber harvest on a Hilltown property, which was a great little video. But do you have questions, Tad, about how that income should be booked, or are you just wondering?
No, I was just really responding to the conversation on the question about the solar. It seems to me that it's really all about what the intent and interests of the the property owner is, and being very clear and upfront, so that in this particular case, this timber harvest was part of the agreement, and I don't know that I would go so far as to say a solar farm would be like that, but I guess there are some examples like timber harvest of, you called it monetizing the property. Sometimes that does happen.
Mm-hmm. Well, and there are land trusts that have working forests as part of their mission, like New England Forestry Foundation, for example, where working forest is very much part and parcel of their purpose. So yeah, it very much depends. But let's see, there's a question here, Mark, maybe it's more of a comment. In New Hampshire, state law says landowner liability is limited. Oh, good point. So there are I think most states have a landowner liability limitation in state law regarding certain, that deals with certain liabilities, but perhaps Connie, I don't know if you want to comment on that. Does this lessen the need for D&O insurance? Most of these I think have to do with limiting liability for those users who cross your property and may be injured in the process of using it for recreation, which is a little different than some of the other things that we have to worry about. Like,
exactly.
Do you want to speak a little bit to the distinction and why insurance is required nonetheless?
Well, yeah, I mean, I think that recreational liability statutes can protect you in certain circumstances, but not all. And so, what they would, they might protect you in a situation as long as you had invited the person onto the property and we're not charging a fee. So that, I mean, that's kind of like the purpose of this recreational liability statute is to protect organizations that offer public access. But it's not it's not going to protect you necessarily from, from certain claims that might be associated with injuries or accidents that happen on your properties. It wouldn't, for example, protect you if you had a volunteer workday or were doing any kind of stewardship. It's not going to protect, it's not going to protect property loss, either. So, if there's a fire that burns down a structure or wrecks certain resources on your property, if requires you to go and maintain a dam or something like that, although there are many, many different laws that would come into play at that point with water management and water diversion. But you absolutely do need property insurance and general liability and an umbrella policy over all of that to cover you. Recreational liability is only going to go so far, and it is not in any way a substitute for D&O. So directors and officers insurance protects you from getting sued personally in the context of your board service, right? So, I mean, that is very much different because it is not related in any way to, somebody who had an accident. It's a claim that, board members were negligent in their oversight or, in their actions, acting as directors of the organization. So absolutely D&O, insist on it. You deserve it for your volunteer service. You deserve the organization making that commitment to you, and definitely a general liability policy.
Great. Are there other questions anybody has right yet? We're nearing the end, so maybe we'll let you continue, Connie.
Okay. Yeah, I'm going to dip back into my screen, and we really are pretty much done with the content for tonight, but I had a question for you. Or a couple of questions, actually. So I did do my top 5 takeaways here, with which, quickly are just, reminding you that as a board member, you should receive and review regular reports, and they should be understandable to you. Number 2, that it's important to honor donors' intentions and pay attention to your organization's treatment of donor-restricted funds. Number 3, that you should receive and review together with your colleagues annual external reports, including an audit or review or compilation, and the IRS 990 filing. Number 4, that you should ensure that there are financial controls in place to address risk. And number 5, conduct a periodic risk review and mitigate risks wherever possible, including through the purchase of insurance. So with those takeaways, we already did questions. So I wanted to try this Menti thing again because, although tonight we had a good period of time for questions, I really wanted to, get a sense of, additional training needs or questions that you might have related to finance and governance, the 2 areas that we've covered so far. I think that Rob would be interested in this as well. I mean, this is really more for, your state service centers and what they can do for you. Did you see Rob Ashley's comment about donor SNAP cloud software and its utility in tracking donations, especially those that might be restricted because they're coming in response to certain campaigns?
Mm-hmm.
So that's like an interesting one to check out.
Yeah, there's that's an interesting topic unto itself, is donor software, or CRM, customer relations management software, that allows you to track your donations. So Snap is one vendor out there. There's a lot of different examples, and most of them, I think, of these sort of current generation of donation software allow you to restrict track donor restricted funds. Great, yeah. You might need to rectify or have those talk to your QuickBooks too. So if you use a separate accounting system, there may be a way to export and have those talk to one another, or sync with one another, if you will. Great. Well, I see some people are jumping off and feel free to jump off as you need. We'll go ahead and close the recording, I think. And Connie, do you have any last comments before I close the recording?
No, I really appreciate your time and engagement. I think this seems like a group, that is an incredible resource to each other because of your experience with different applications. And so, I hope it was helpful to you to hear not only from me, but from your colleagues this evening. And I'm looking forward to seeing you next week and talking about land protection.